Now we're going to turn to Asia, and we're going to talk about Asia for a minute. But one of the things that we wanted to touch on before we go into China is this German wholesale prices, because Germany is very much connected to China, and especially when we look at exports, imports, and the wholesale prices going up, and especially when we look at where we sit today, speaks more to, or even more to, the global market and some of the pressures that are going to come down into the European theater, especially when we start talking about China and some of those price increases that we've seen on exports while they try to protect some of the internal sides of their pricing metrics. So then let's just do a quick overview of where we sit today with China and where some of the things reside. So the party state now thinks it's time to increase its ideological game, as we've been talking about. And they want to increase ideological and political education, improve the quality of that education at a grassroots level. So a scientific evaluation system will be established to evaluate leading cadets on their ideological and political work in order to make soft targets turn into hard constraints. No slacking off now, as the party wants to survive and celebrate another century. Expected more waves of Xi thought propaganda. So that's as we continue to progress through, I think these are some of the key components, especially as the economy softens. So again, when we take a step back, most countries or most people within those countries won't really riot or demand change if everyone feels good. If everyone's eating, making money, economy's growing, everyone's happy. Even if you're not thrilled with the position of political prowess that you have or the political discontent that you may hold, you're not going to do much. But when you look at China and some of the struggles that are coming down the road, it's going to become more important to have people buy into the communist backdrop to keep people happy and moving forward. So let's now talk about what has been done to try to adjust that. Well, let's look at the RRR. So the RRR cut. So the cut reflects concerns about the state of the banks themselves. And I think so Trivium does a good job of covering this. Efforts to help the private sector usually involve targeted RRR cuts, whereby only small banks, which lend a far greater share of their loans to small private companies, are allowed to reduce their reserves. Instead, this was broad. So because it was so broad, it actually impacts small banks more, because now it takes down their rate that they can issue, that they can charge, or at least give to potential clients, which actually benefits larger banks. But given this blanket cut frees up liquidity that is unlikely to make it to small firms, again, just based on where it resides. We suspect the cut is designed to help banks deal with liquidity pressures arising from deteriorating asset quality, as well as the fallout from both the pandemic and wealth management product reform. As such, the cut shouldn't be seen as broad easing, but rather as a part of an effort to ease pressure on both banks and small private firms. Because again, remember when we were talking about asset quality, this has become, what is your bad debt expense? How much do you have on your sheets? What are the assets you have backing it? Because there is a very big concern on quality, and that continues to become the issue. So, and taking into context, we see the cut as structural, and by we, Trivium, sees the cut as structural move, and one that may be the first among several meant to offset other moves that are including long-term tightening in bank liquidity. Friday's move wasn't about juicing growth, nor was it the start of a policy easing cycle, but it may well be the beginning of ongoing efforts to rejigger the structure of bank funding markets. And I think that is the biggest issue, is it's not going to stimulate as it is to shore up balance sheets. Not to say that one can't become the other. It's just this big shift, and we'll talk about what that is in the next slide when we look at some of the different backdrops of social financing and where that disconnect is, because it's important. But before we do that, the Biden administration is discussing proposals for a digital trade agreement as it seeks ways to check China's influence in the region, according to people familiar. Details of the potential agreement are still being drafted, but the pact could include countries such as Australia, Canada, Chile, Japan, Malaysia, New Zealand, and Singapore. The deal could set out standards for the digital economy, including rules on the use of data, trade facilitation, and electronic customs arrangements. And it's being structured to be able to include other countries fairly easy. And again, this is just another way to get some of those ASEAN countries further into our influence, especially if we start layering in India to try to counter some of the expanse that China has had. Now, just to go deeper into external trade, because when we think about some of the trade aspects, this is going to lead from trade into some of the other issues that we've seen with the RRR and what is happening in general. So exports rose 32.2% year on year in June, up from 27.9% rise in May. This was above the consensus forecast of 23%. The 2-year average growth for exports accelerated to 15.1% from 11.1% in May. Imports rose 36.7% in June from a year earlier. This was slower than May's 51.1% rise, reflecting a higher year earlier base. The consensus forecast was 29.5%. On a 2-year average basis, imports recorded an 18.8% gain, up from May's 12.4%. So we thought things were going to slow, but our expectation was based on the imports, because remember, China is a country that's importing raw materials, that's importing semi-finished goods, and then is putting out either exporting semi-finished goods or the finished product. So imports are always a very good indicator of near-term exports. So even though we thought things were going to slow, we were expecting a higher number than where exports were going to be. Did we think it was going to be 32.2%? No. We thought it was going to be upper 20s, low 30s in terms of where things sit, but here we are. So now what comes next? And you can see that imports have started to slow again, and the pressure is mounting on price. And that's where we continue to see some of these pressures going forward, because price is going to be indicative of where does this go as you look at trade balance. So trade balance has gone up. Things have gotten a little bit better, but going forward, as we look into through the remainder of Q3, that's where we see some of the pressure, and that's where we see it growing as inflation catches hold, as some of the demand slows down, given the fact that new orders have come under pressure, which is another leading indicator that things are getting a little bit slower. So let's just look at this a little bit differently. So most analysts were expecting weaker read because of the COVID-19 related issues, but in actuality, it created this acceleration, and some of the issues that we saw are going to reverberate through July and less in June, because if you think about what that did, that held back capacity. So the moment it was released, they could dump a lot of that into the system. Now that you emptied the port of what was available or what was supposed to be in the market, that creates this essentially this vacuum behind it. And I think what we were saying is that you're going to have some of that residual that's going to carry into July and not so much June, because you were able to move that through. So the stronger than expected increase in exports may reflect the fact that Chinese companies are passing through higher costs to overseas customers, which they are. This means that the value of exports rose even if the number of products sold did not grow as much. So that's the other thing, the component. So let's just use an iPhone for an example. So if before they were exporting 100 iPhones at $10, and now they're exporting 15 iPhones at $18, that's net going to be a benefit, even though on a tonnage level it was down. So that's another capacity component where it's not so much the value, it's the value going up, not the tonnage, which is one of those caveats that we have to consider when we're looking at what is the growth. Because when we talk about resid and shipping, that's where we see some of that slowing down, but yet this is saying it's accelerating, but it could be an acceleration of price, not tonnage. So this means that the value of exports rose if the number of products sold did not grow as much. Higher commodity prices rather than strong domestic consumption likely also explains the continued strength. For example, the value of iron ore imports increased 83% year over year by value last month, but tonnage shipments were down 12%. So that's just another example of what we're seeing. Exports continue to provide support to the Chinese economy last month, but here are some of the headwinds that are laid out by Trivium that I think are very valid points. Chinese exporters need to raise prices not just to cover higher input costs, but also to offset renminbi appreciation. This risks making Chinese goods less price competitive, which we've started to see. As economies in the West lift COVID-19 restrictions, overseas household spending should shift from goods manufactured in China to domestic services. So remember in segment 2 and 3, we talked about the movement from durable goods into services, which again is going to shift how some of this is movement and is going to limit some of the growth into China. China's economy won't be able to ride the wave of strong overseas demand much longer, which is why when we look at some of these components, so CPI was just below expectations, was expected at 1.2%, actual came in at 1.1%, but PPI, again, back to that producer price index, 8.8%. This is going to get passed through to someone. How does that get passed through? And that's where we continue to see these pressure points coming in, because that's the inflation we're going to import. We're going to import that inflation, and because we're going to import that price that is getting passed through. Now, when you look at new loans and aggregate financing, the money supply grew a little bit, but there's some caveats to that. So M2 went from 8.2% to 8.6%, M0, 5.5% to 6.2%, but M1 went from 6% to 5.5%. So we're seeing some shifts in terms of where this is being calculated and where some of that movement is coming through as liquidity is injected into one area and then removed from another as they try to manage. Like, the PBOC had 10 billion yuan renminbi assets or bonds expiring, and they let it expire. They didn't issue new, so they drained a net. So they issued 10, expired 10, liquidity is flat. And those are things that they're trying to do to mitigate this triple R cut that went from 12.5% to 12%. So it's I mean, basically, if you're watching our shows, you know that isn't a surprise to us because we were talking about a real component. But now when we look at Chinese customs, crude oil increased 3% to 261 million tons. Gas was 23.8% increase. Soybeans was up 8.7%. Corn was up 319%, and wheat was up 60%. So again, when we look at what is happening on the inflation side, on the CPI level, those are going to be very important when we're thinking about not only food to people, but also feed to a lot of these livestocks. So now let's go deeper into the Chinese deposit cut. So we have the cut of 50 basis points. And what does that mean in general? So one of the things that we've talked about is that there's about 1.1 trillion yuan MLF or medium-term lending facility funds expiring over the next few months. So when you think about the cut is supposed to reduce firms' borrowing costs by reducing banks' funding costs, even as the central bank continues to keep a leash on overall interbank capacity. Well, how are they going to do that? Again, the medium-term lending facility. On July 15th, renminbi 400 billion worth of MLF funds are due to mature, which the PBOC has talked about not rolling over. So that would take 400 billion. Remember, there's 1.1 trillion due. This would take 400, or at least some of that 400, to mitigate some of that movement. So when we think about credit impulses, that's how they're going to manage some of that credit impulse. So in effect, the PBOC replacing a relatively high-cost source of bank funding, MLF, with low-cost long-term source of funding. If Beijing's motive for cutting the triple R was limited to help small firms alone, the cut would have applied to only small banks. Instead, it was broad. So again, they're talking about benefiting and helping SMID caps, micro caps, but this is just not it. That this isn't going to create that setup. However, we expect, and this is however we is Trivium, that the blanket triple R cut was due largely to concerns about banking sector liquidity, which is what we've been talking about the last few weeks, is the liquidity becomes a bigger conundrum, especially when you think about the distressed debt that's been caused not only just by the pandemic, but also that excessive borrowing and that off-balance sheet capacity that we continue to see. So that means they don't have to recognize bad loans the same way, so they don't need to hold additional capital against the loan. So they're trying to adjust how the regulators are looking and providing support for distressed debt. But regardless of whether a delinquent loan is recognized, it's a drain on liquidity. That's because the bank still needs to pay interest on wholesale funds and deposits, even as a large number of loans fail to generate interest payments to the bank. So you're still seeing these issues, which is why there's going to be more to come, whether it's through the RRR right away or elsewhere. They're going to have to do something to shore up their financial system because it's going to come under additional pressure. So then when we look over so if it's sufficient to say that WMPs were responsible for driving the growth of bank impairments in 2020, which is those wholesale sides. So Friday's RRR cut reflects a significant change in liquidity management, but a new wrinkle in the goals of monetary policy as they tried to still stimulate the local businesses, but they can't do it the way they're doing it. So what's more, the cut is unlikely to be an isolated event, but investors need to understand that even a series of RRR cuts will have very specific purpose to support banks and lower funding costs in order to avoid bank liquidity squeezes. But these measures won't be about pumping up credit growth overall, nor will they offer significant support to the broader economy, which is what we're trying to drive home at this point. So then when we look at the monthly supply, this gives you an idea of how they're managing it and how they are going to continue to keep this essentially muted versus that bump that we saw, especially in M2 as we went through 2020. So M1 supply, usually a leading indicator, rose 5.5% year over year in June, lowest since April of 2020 versus 6.1% year over year. Real M1 adjusted for CPI rose 4.4% year over year in June, lowest since July 2020 versus 4.8% year over year prior. So again, that movement of some liquidity going in, but we're still seeing it get pulled out, again, managing those different positions. So then when we look at PPI, this gives you an idea of the spread and where PPI is versus headlines. So the fall in the headline index was mainly due to a weaker base effect in PPI. Prices are still increasing on a month-over-month basis, but at a smaller rate of 0.3% month-over-month versus May of 1.6%. PPI remaining at elevated levels is not great for growth, obviously, as the council meeting flagged up the prospects of the RRR cut as a way of offsetting some of that inflationary drag. But as we just went through, there's going to be a lot behind that. There's also things that are being done on the 5-year commerce plan. So when we think about the commerce plan, the plan just lost it. I apologize. So the plan is focused on trying to increase, obviously, retail sales, a proxy for domestic consumption, but their goal is now at a 5% annual for the next 5 years, which is a sharp drop from the 10% growth that was targeted because we continue to see the consumer disappointing, and they're trying to move the goalpost so it doesn't look like it's a huge failure, especially when we're considering the dual circulation strategy. And then this is looking at the new cumulative loans. So we're still seeing a little bit of growth, but on new loans, but on aggregate financing, it's still below 2020 as they're letting some of this excess expire. So new loans are still growing, but it's, again, the actual number is still coming down, which is why when we then look at China aggregate social financing, you're seeing where some of that is coming in. So monthly aggregate social financing went to 3.6 trillion, up from May's 1.92 trillion, and beating the consensus of 2.89. But it's coming out elsewhere because China's premiers to support micro, small, and medium-sized enterprises. We should combat monopolies and unfair competition, and should make the recent measures of RRR cut more structural to help enterprises and labor-intensive industries to ease financing difficulties. But it was aimed across the board. In order to get to that micro, small, and medium, you need to accelerate it at the lower level, like the micro and small banks, not the large banks. And that's where that means that I think it's going to get more targeted where we're not going to see a blanket cut, but more cuts at the lower end to try to provide some of this, because Premier Lee will adopt comprehensive measures against commodity price pressures, will not resort to flood-like stimulus. Again, like it's a measured move of stimulus, of some RRR, allow some of this to expire and bring down the cost of commodities by issuing from state reserves. So then when we look at China weak infrastructure spending, it's going to pick up because there's extremes, but how much can they allow? Because this is where they've seen their biggest overhang in bad debt, is investing in infrastructure that just is irrelevant, doesn't work, well below generating any type of revenue, which is some of the pressure points. But they also want to bring real estate down. So they need to generate some sort of growth. And at this point for them, infrastructure is the lesser of two evils, though both of them will remain under pressure. All the while, China's bond market is still mostly rated in the AA or greater. So we all know how that turns out when everything is AAA, because then overnight you realize it's actually not AAA, it's somewhere in the mid Bs to high Cs. So again, we've seen that rodeo before. So then when we look at foreign direct investment, when non-financial foreign direct investment in China rose to 607.8 billion yuan in January through June, and it's just some of this is coming under more scrutiny, and we expect this, as we've been talking about, to continue to slow down. So you have the consumer slowing, you have exports that are going to slow, you have FDI that's going to slow, you have government spending that is muted. How are we going to get some of this growth? And that's where we see some of those headwinds. And now this is from the China Beige Book, looking at the automotive side. So you can see just in terms of what Q2 looks like, the inherent slowdown that we're seeing on some of this manufacturing, which is then resulting in, on the manufacturing, the wage rate down, workforce down, work week down. All of these things are pointing to why, and this is just a subset that they offered on Twitter. China Beige Book is fantastic. I highly recommend them as a follow. But this gives you an idea of where some of these slowdowns are coming and how it's going to continue to carry through Q3. So then when we look at something a little bit different, let's look at India now. So the budget deficit continues to grow in India. And this is why we continue to see some of these pressure points, especially when we look at the increase in taxes on petrol and gasoline, diesel. How are you going to lower those rates when you're already at such a budget deficit? And you can see how it doesn't really get any better. But how are they going to borrow if the 10 years creeping higher and their inflation continues to remain above 6%? So then when we think about the inflation side, here's where we're talking about the inflation remaining well above the inflation target range of 6%, as we were saying it was going to. And our view was that it was going to stay sideways. We weren't going to see a huge surge to 7%. But again, this gradual sideways move that is now going to trend up, not down, because this was issued when they were still in lockdown. So now they're out of lockdown and emerging from it. So there's going to be an acceleration of inflation as prices go up. So when we look at industrial production, the estimate was at 32%, actual came in at 29.3%, because even though they're coming into, and this is for June, even though they're coming into a point of growth, the economy, the industrial side, still is struggling. The consumer is still getting better, but the economy and that comes down to input costs, global demand, and where some of those overhangs are. So then when we look at inflation across the board, in June came in at 6.3%. But the shift, look at fuel, you look at tobacco and alcohol went down, but food and beverage was up. Housing was flat. Clothing was up. More importantly, though, food was up, and fuel and lighting was up. And those two things are not going down anytime soon and are going to keep them being fairly elevated and that pressure throughout the system. So then when we look at food inflation to ease in July, but again, it's only going to be temporary. We're not going to see a near-term, a long-term bump, and it's only just because the comps are easier when you look at year over year. but the trend is up as we highlighted in segment 1. So then when we look at industrial production per sector, you can see that in terms of where we sit, mining was the biggest problem. And then when you look at manufacturing, mining and manufacturing, so the industry side was down, but let's look at it against January and Feb. The bigger pressure was mining, but manufacturing is the one where we see some of the bigger headwinds going forward. When we review what are some of the shipments doing, what are some of the demands abroad, and that's where we think manufacturing and the industrial side is going to continue to underperform, resulting in less diesel demand, less movement in the economy. While gasoline continues to get a little bit better, the consumer continues to improve, but it's just that exporting side, that industrial side is where we see some of those slowdowns. And it's not just India, because then when we look at Japan, here's where we look at some of those machinery orders were up to 7.8. You know, some of this is getting a little bit better when we look at some of these orders for June. But when you look at what has happened as we came from June into July, we've had some additional COVID cases, some additional slowdowns, where we're going to see some of these pressures on new orders and current orders. And then on the price index, you can see the price index still remains elevated. And again, this is being exported. So when we look at price index year over year at 5%, price index month over month still at 0.6%, that is being exported. Japan is an exporting nation. They import raw materials, semi-finished goods, export finished goods. This is where, again, importing inflation, this is going to come into the U.S., keeping our movement higher in terms of that inflation side and keeping it sticky. Machine total orders declined unexpectedly. That's something that we think is going to continue into July, just given the Olympics, some of the pressures that we have in terms of restrictions, emergency protocols back in place for COVID, and to protect against some of the spread while the Olympics is going on. These are some of those issues that we think will reside overall. I know we covered a lot of stuff. Hopefully it was helpful. It was interesting. And if you have any recommendations, comments, please reach out to us on Twitter, on comment section within YouTube. We'd love to hear from you. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.